Hello learner, welcome to Manifested e-learning platform. My name is FAM Nengwiri, and today, ladies and gentlemen, we are discussing about the financial modeling and data analytics paper, December 2023 sitting. The focus is on question 23, and you are presented with the following information right on the left of your screen here. You'll be given the stock name, Z-Term Kenya Limited, Car Assemblers, Ujenzi Centum, Cement, Kilimo Bora, Nairobi All Share Index, and you've been given the ticker symbol right over here. You've also been provided with the portfolio compositions, and all of these total to 100%. And how you can be able to just quickly check is by scrolling down over here, and you can see that the sum is 100% right here. You are presented with the weekly returns for all of those companies, or all of those 4 companies, including the Nairobi All Share Index. Now, you are required to calculate the weekly returns for each of the individual stocks and the Nairobi All Share Index, calculate the wage portfolio, the average portfolio return for the historical period. You're told to calculate the standard deviation for each of the individual stocks and the Nairobi All Share Index. Then you're told to calculate the standard deviation for the portfolio returns to assess its risk, and to calculate the beta for each individual stock of the portfolio, which measures its sensitivity to the market movements. And you can see these are 20 marks. This is 20 marks question. So the way I've decided to arrange the information is to arrange it as you can see on the right of your screen over here, to calculate the weekly returns for each of the individual stocks of the Nairobi All Share Index. So we just pick average, not average A. You can see the average right over here, and the average of what? We want to pick the average for Z-Term Kenya, to pick the average values right here. Up to there, close the brackets, then you enter. So we're saying that the average return should be negative 0.2%. Let's put it to maybe say 2 decimal places. Like that. 2 decimal places is up to there. And if we were to drag it moving towards the right, we wouldn't be wrong, because we're saying that it picks the average for car assemblers. You can see car assemblers, it picks it right there. So that's what they're saying, the average, the weekly returns is given to us right there. Escape. We move ahead and answer part B of the question. You are told to calculate the average portfolio return over the historical period. We have been given the portfolio composition, and the portfolio composition can be linked with this top part right here. The portfolio composition is there. Enter. And we link it with all of them towards the right, Control R, like that, so that you can be able to pick the portfolio composition. Remember, we have computed the average weekly returns above here. So we just link it with up above there, and then we drag it, Control R, like that, the same values, excluding the All Share Index. Because this, all of these portfolio composition total to 100%, as you can see down here, we cannot be able to include the All Share Index into our portfolio. How do we get the average portfolio return? Pick plus, we open the brackets, that value times the average weekly return plus that value times that value, close the bracket, the portfolio composition multiplied by the average weekly return, close the bracket, and then we add finally the portfolio composition for Kilimo Bora, and we multiply that with the average weekly returns, like that. Oops, that, close the bracket, and we enter. So I think I didn't put I didn't open a bracket here, that's why it's giving me those values there. So we open a bracket over here, and then once we close it like that and we decide to enter, it will actually be okay. So we only want it into the 2 decimal places, so we just sort of reduce it like so to 2 decimal places, like that, 0.35%. Now once we've gotten our portfolio return as 0.35%, we can move on to part C. Calculate the standard deviation for each of the individual stocks and the Nairobi All Share Index. That's 4 marks. So average standard deviation would be, you pick STD, stud dev, not P, because we're not picking for the entire population. We want stud dev, standard deviation for the sample. So we double click that, and we can be able to just pick the value for these values here. We highlight this value for Z term. So we highlight it down like that, and it picks to calculate for us the standard deviation for Z term. And we move up over here like this, we can be able to see we already have that given to us there. And if we were to drag it moving towards the right like so, up till All Share Index, it will actually pick the standard deviation. Remember, for example, this one is picking the standard deviation of the sample for the index, for the Nairobi All Share Index right here. Part D, we asked to calculate the standard deviation of the portfolio returns to assess the risk. And we're saying for us to be able to do that, we will need to consider the weights. And the weights would mean that we've already had the standard deviation over here, compared to us over here, but now we need to factor in the weights. And we're saying it's going to be, we pick that standard deviation times its corresponding weight over here. The corresponding weights were given to us over here. We can use that, or we can even use this portfolio composition right over here. So we close the bracket and we open another one over here so that it can actually pick the values as the way we want them. Then we add the standard deviation over here. I forgot to open the brackets, so we open it right above over here. You can see it on the formula bar here. So we open the brackets there, and then we multiply that with car assemblers, corresponding portfolio composition weight. We open the brackets, we pick Ujenzi Bora standard deviation, weekly standard deviation, times the Ujenzi cement over here. Then we close the brackets, plus we pick this value here and we multiply that against that value there. Open the brackets and we close the brackets like that, and we just click enter. So we can be able to put it in form of weights, and we can say it's about 06.02% standard deviation. So standard deviation of the portfolio is given to us there. So we pick the standard deviations of the individual securities and we multiply them by the corresponding weights. Then finally, we are asked to calculate the beta for each individual stock in the portfolio, which measures its sensitivity to market movements. The beta is given by covariance of the market and stock, so you can put it like so, covariance of the market and the stock. Then we divide that against the variance of the market, like that. And that's what we're saying we're going to do. Covariance of the market and stock, or covariance of the market. So we pick covar S, because we're looking at a sample, covariance, and we open it up right over here. Covariance of what? Covariance of the market. This is the market over here, so we highlight that part. Covariance of the market, and on the second array here we put the stock itself over here, bearing in mind like that, covariance of the market and stock like that, and you can see what we've done, covariance of the market and stock. So we can lock the one for the market, so we are saying this one for G is one that you can be able to decide to lock, F4 and F4. Why are we locking it? Because we want to ensure that the covariance of the market remains like that. And then we do what? We divide now, divide by, you can see the variance like this. We divide against variance, or we just put it like that, variance of the market. But now, before we do the variance like that, we can say okay like that, because that's just the covariance like that, because you can see from the formula by just the covariance. Then we continue and say divided by the variance, not var p but var s, sample, variance of the market, based by this variance of the market. So we pick the variance of these values here and we lock it. So press F4 like that and we close the brackets. That there, that's our beta, 0.0932. And if we are to drag it moving towards the right, let's just confirm. Covariance, remember we have locked, that's the purpose of locking. This one, covariance of the market. Look, this one has moved from initially Z term to now car assemblies. You can check the previous one over here, escape, check the previous one, you see it is now currently at Z term over Z term here. Now we move on to the second one, it actually picks, but it remains, this one remains, the variance of the market remains, the covariance of the market remains. So we can be able to say that the model is foolproof. Control R. But let's see if we're actually doing this the correct thing. We want to try and prove if we were to pull it towards the right, if you're going to get a beta of 1. You can see we already have beta of 1. Beta of the market is always 1. Because it's covariance of the market, it's covariance of the market against the market divided by variance of the market. We always have that value being 1 there. And so with that, ladies and gentlemen, we have come to the end of question 23. Thank you for being with Manifested Publishers. We are always here for you. Be blessed.
Welcome, learner, to our lesson today. We are looking at the human resource management subject, and this is under the Manifested Publishers Learning Platform. And in today's lesson, we are looking at reward management, and under this we are looking at 2 areas, pay structures and wage systems. We are going to start with pay structures, then we proceed to pay structures, then we proceed to wage systems. So dear learner, pay structures in reward management do several things. So one, they provide a framework for managing pay. Pay structures will provide a framework in terms of entry point, progression in relation to the workers. Then number 2, it contains, pay structures contain the organizations, the pay ranges or scales for jobs grouped into grades, maybe grouped into grades, into bands, or job family level. So it depends on which one an organization has selected. Then 3, pay structures define the different levels of pay for job groups or groups of jobs by reference to their relative internal value. So this relative internal value is usually defined by the process of job evaluation. And this is done in consideration of the external relativities of this particular job, so that the value of that job is determined and the worth is determined within the job hierarchy within that particular organization. And then pay structures also provide the scope for pay progression in accordance with the performance, competence, contribution, or service. And what this 4th point here helps an organization to do, you may have 2 different employees. And these two different employees, though they may have been employed at the same time and they're in the same grade, but their progression now will depend on the performance these particular employees have given to the organization, their competence. One of the employees might, for example, have gone through training, has gotten on-the-job experience, and that particular employee is contributing more, and that employee has made, for example, 5 years or 6 years of service to that particular organization. So when you take into consideration performance, competence, contribution, or the length of service, then that one can help an organization to determine what would be the progression level of a given employee or a set of employees in a given organization. So that is as far as the pay structures are concerned, in terms of what they provide in relation to human resource management. So what are some of the guiding principles for pay structures when an organization is providing a pay structure? So what are some of the things that they should look at? So pay structures, dear learner, pay structures, what should be the guiding principles in terms of pay structures? So pay structures should be appropriate. So 1, should be appropriate to the culture, a culture in an entity. Now, for example, if you are dealing with, say, public service, then the kind of pay structure that should be adopted should be a culture, should be an appropriate pay structure that can take into consideration the culture. And as you have noticed within the civil service ranks, what happens is that employees work for long durations of time, and in most cases they look at the aspect of seniority. So if you are looking at the aspect of seniority, and the culture is that employees need to have loyalty and commitment, then the appropriate pay structure that should be, for example, adopted in the public service should take into consideration issues of performance, issues of seniority, and issues of length of service, so that becomes appropriate to that kind of setting. Then secondly, should facilitate a pay structure, learner should facilitate achievement of transparency, should also facilitate the achievement of equity, should also facilitate the aspect of consistency in salary administration. So what you're saying, if you are looking at the pay structure, then that particular pay structure that is adopted by an organization, a guiding principle should be that this pay structure should facilitate equity, should facilitate transparency, should facilitate consistency in salary administration, so that it helps an organization to, for example, say 12 years of experience, for example. So if you have 3 workers, then this particular structure should provide that this employee who has been in an organization for 12 years could be moving maybe on an annual progression in terms of, say, 3 years, or maybe annual increments and so on. So that becomes a very useful principle in relation to designing pay structures within a given organization. Then it should also facilitate another guiding principle. A pay structure should facilitate ease of administration. Take for learner, if an employee has been in one lower, for example, grade and is moving to another grade, so the pay structure should be made in such a way that they could be overlapping, so that that transition becomes smooth and an employee is able to be adjusted in terms of that particular next grade. Then should also facilitate management control of pay. So the system should be good enough so that an organization should facilitate management control of pay issues, so that in case an employee has a complaint, it is possible to be able to look at the pay structure and articulate issues in relation to how this particular pay structure is supposed to be implemented. So that again becomes one of the guiding principles, and it should also be capable of responding to market pressure. Now, what this means is that an organization does its pay structures in the context of, say, a labor market. So in this labor market, there could also be, for example, changes. Let us take an example. Government may provide minimum pay. So if the government is providing for minimum pay, the pay scales that are being provided, or maybe the pay structures that are being provided, should be able to accommodate the labor market changes, like the minimum pay that are mandatory, so that it pays above that minimum pay to avoid challenges that could come from the legal. Should also encourage career growth and development. So, dear learner, what this does, if you look at many systems within working environments, at the lower level, the pay structures would look like they have got lesser, for example, rewards or maybe less pay. But as people move up the ladder, that particular growth enables those who remain in that particular organization to grow in terms of their careers and to develop to better, for example, emoluments within that particular organizational setting. And that's why one of the guiding principles of a pay structure should be to encourage individuals to make an effort so that they can grow in their careers and be able to advance. So these, dear learner, are some of the guiding principles that should be taken into consideration when designing pay structures within a given organizational setting. Then these pay structures, once you have looked into these, say, guiding principles, it is important to note that there are different types of pay structures that organizations may make use of. Types of pay structures. we can mention types of pay structures. Now, the types of pay structures may vary, and an organization may use specific ones or maybe a combination. And the first type is what is referred to as the narrow graded pay structure. Narrow graded pay structure. Narrow graded pay structure. Narrow graded pay structure. So the narrow graded pay structure is a type of pay structure. And then you have the broad graded pay structure. Broad graded pay structure. Broad graded pay structure. So that is also a different type of pay structure that an organization can make use of. And then you have broad banded pay structure. Broad banded pay structure. Broad banded pay structure. So that is number 3. And then number 4, apart from those 3 structures, you have a career family pay structure. Career family pay structure. Career family pay structure. So you have a career family pay structure, and from that another organization can maybe be able to use that. Then you have a job family. A job family pay structure. And then you have number 6, spine pay structure. So these ones are examples of types of pay structures that an organization may have. So you have the narrow graded pay structure, you have the broad graded pay structure, you have the broad banded pay structure, career family pay structure, job family pay structure, and spine pay structure that an organization can be able to also use in relation to the kind of pay structures that organizations may design or may formulate for purposes of payment of workers. So, dear learner, in today's lesson, we have looked at the reward management topic, and in that topic we have looked at the area of pay structures and wage systems. And initially we have now looked at what are pay structures in terms of what they provide, and we have indicated that number 1, pay structures provide a framework for managing pay. Number 2, contain the organization's pay ranges or scales for jobs grouped into grades, bands, job family levels. Number 3, pay structures define the different levels of pay for jobs or groups of jobs by reference to their relative internal value as determined by a job evaluation to external relativities. Number 4, pay structures provide scope for pay progression in accordance with performance, how the employees perform, competence, contribution, or service. Then we have also looked at now the guiding principles for pay structures, and we have indicated, dear learner, that pay structures, number 1, should be appropriate to the culture in an entity or an organization. Number 2, pay structures should facilitate achievement of equity, consistency, transparency in salary administration. Then number 3, pay structures should be flexible to respond to changes, for example, in skill acquisition, seniority, for example. Number 4, pay structures should facilitate pay structures should facilitate ease of administration, administration of the pay systems. Number 4. Number 5, pay structures should facilitate management control of pay. And then number 6, pay structures should be capable of responding to market pressure. For example, the labor market minimum wage, that is minimum pay that is provided by government. And number 7, Lana, pay structures should encourage career growth and development. So those ones are 7 guiding principles for pay structures. Then we have gone ahead, Lana, and looked at types of pay structures where we have indicated that there could be narrow graded pay structures, or number 1, narrow graded pay structure. Number 2, broad graded pay structure. Number 3, broad banded pay structure. Number 4, career family pay structure. Number 5, job family pay structure. Number 6, spine pay structure that organizations may use maybe independently or in combination. So your assignment for the lesson today, dear learner, assignment, you have your assignment. Describe your assignment, describe the guiding principles for formulating pay structures. So the assignment, dear learner, your assignment for today's lesson, which was pay structures and wage systems, describe the guiding principles for formulating pay structures. So that is your assignment, dear learner, and thank you for being attentive and participating in our lesson today. Dear learner, welcome to our human resource management subject. Today we are looking at performance-related pay, which is a subtopic in the reward management area of human resource management. And performance-related pay, as is used in human resource management, performance-related pay scheme is a remuneration system where reward to an employee depends on the performance of an employee, and the performance of the organization. So you can see, dear learner, there are two things. Performance-related pay is dependent on how the employee performs and how the organization performs. And that's why the issue of relationship comes in. So performance-related pay. So the pay is at 2 performance levels. The employee is expected to perform at a particular level, and the organization itself is also supposed to have performed at a particular level for the performance-related pay. And these 4 main features are the basis of the scheme: consolidated pay increases, variable pay, and pay progression. So when it comes to the basis of the scheme, in relation to performance-related pay, the basis of the scheme must be defined, and the basis of the scheme may, for example, be maybe organizational performance, So the way the organization performs may be the basis of the scheme, so that you look at the overall organization performance, and then the performance-related pay could be determined. Maybe you may want to look at it in terms of maybe a bonus, and the bonuses could be, for example, of various types. So the basis of the scheme may be organizational performance, which may be affected now in terms of the bonus or bonuses to be paid. Then when it comes to the consolidated pay increases, maybe the pay may be increased, pay may be adjusted, pay may be adjusted based on particular parameters that they may, for example, come in, and it will be in a consolidated way, so that a particular specified amount may be the total amount that is given as an increase, as a pay increase, and that may be given maybe at one point in time or over a period of time. And then when it comes to variable pay, the way the word suggests, this may vary and may be paid one-off payment. So let us say in the month of the end of December of a given year, an employee or a group of employees have performed and are supposed to be provided with a variable pay. Then for that particular end of year, maybe December or January, those particular employees, their pay is varied and then readjusted. Or maybe it is varied at one time, and then it's a one-off adjustment, and that becomes the variable pay, which is a feature of performance-related pay. Then there could also be pay progression determined. This could be determined for a given period. So you may, for example, say there will be pay progression maybe at the end of 1 year, say maybe in the month of July or in the month of January, the pay progression will take place, and it will be progressing maybe at a particular percentage, maybe at say 5% of the prevailing, for example, scale and so on. So that again could become pay progression as a feature of performance-related pay. So these are some of the main features of performance-related pay that we have indicated. Looks at specifically the performance of the individual and the performance of the organization. So what could be some of the suitable conditions for performance-related pay? Suitable conditions for performance-related pay. Suitable conditions for performance-related pay. And by this, dear learner, what we mean, what features should prevail on the ground, or what circumstances should prevail in an organization to make it suitable for an organization to operate a performance-related pay system. So one, an organization entrepreneurial culture. An organization should have an entrepreneurial culture. So where employees are entrepreneurial, then these employees can invest their ideas, can invest their innovation, and that one can lead to better performance of the workers and the organization. So there should be a practice of employee involvement in decision making. So for you to have a successful performance-related pay system, then workers in that particular organization should have gone through a practice of being involved in the decision-making process, so that they can participate fully in ensuring that they can be able to bring in the aspect of performance-related pay in terms of agreeing on objectives. And then number 3, transparency in salary and wage, or what you are calling reward management matters. There should be transparency in salary and wage or reward management matters, so that workers can be able to have confidence in this particular system. Then 4, clear objectives of performance. A clear objective of performance must be in that particular environment, so that it is very clear in terms of what is expected, in terms of the management and so on, in terms of the workers. So that could be very, very clear. Then number 5, supervisors and managers should be well versed and skilled in managing performance. Then there should be a clear communication channel in the organization. And then number 7, full support of the top management regarding performance related pay. So what you are saying, Lana, there should be full support of the top management regarding performance related pay. Is it? And then number 8, payments should be made when they are due to gain the confidence of employees in the system. So Lana, workers will give the system a benefit of the doubt, and they will want to see one cycle. So if they agree on what is supposed to be paid, they produce on their part and so on, the organization gains, so the workers will be waiting to see, will the management make that particular commitment in terms of payment? So if those payments are made, then workers can support the system. So these are some of the factors that should be suitable conditions for performance-related pay to succeed within a given organization. So today, Lana, we have looked at the performance-related pay area of reward management, and we have listed some of the suitable conditions. We have also looked at the main features, and we can very quickly revise what we have done today. And we have said that performance-related pay scheme is a remuneration system where reward to an employee depends on the performance of an employee and the performance of an organization. And the main features of performance-related pay are 1, the basis of the scheme, then 2, consolidated pay increases, then 3, variable pay, then 4, pay progression. And we have also indicated and discussed that when it comes to performance-related pay, for it to be able to succeed, dear learner, there are certain conditions that should be suitable, or an environment that will be suitable for the success of performance-related pay system. And we are saying that number 1, an organization should have an entrepreneurial culture. Then 2, there should be a practice of employee involvement in decision making. Then number 3, there should be transparency in salary and wage or reward management matters. Number 4, clear objectives of performance should be set out. Number 5, supervisors and managers should be well versed and skilled in managing performance. Number 6, there should be a clear communication channel in the organization. Number 7, full support of the top management regarding performance-related pay. And number 8, payments should be made when they are due to gain the confidence of employees in the system of performance-related pay. So, dear learner, those are some of the suitable conditions under which performance-related pay system can be able to be operated objectively and successfully. So before we terminate our lesson today, you have an assignment. Your assignment for today, examine the conditions that may make the performance related pay system succeed in a workplace. So dear learner, your assignment, examine the conditions that may make the performance-related pay system succeed in a workplace. So that's your assignment, and until our next lesson, bye-bye. Dear learner, welcome to the lesson today under the Manifested Publishers Learning Platform, and we are continuing with our human resource management subject, and we are looking at the lesson on reward management. And in reward management, we have an area on salary administration policy, which we are going to look at today. And when you look at a salary administration policy, it is a guideline that is used to determine, implement, and review salary levels and structures in an organization. So this is very critical because payment of salaries and rewards to workers need some format or some arrangement where decisions which are being made are made consistently in a transparent manner and can be verified. So a salary administration policy provides that guideline to be able to assist in the determination, implementation, and review of salary levels and structures in a structured way in a given entity. So in our lesson today, we are going to look at the importance of a salary administration policy. We will also look at components of a salary administration policy and the structure of a salary administration policy. So we will start with the importance of a salary administration policy. Importance of a salary administration policy. Salary administration policy. So why is we have seen that a salary administration policy is a guideline, and this guideline provides a direction in relation to determination, implementation, review, and looking at the levels of salaries in a given work environment. So when it comes to the importance, one of the reasons why a salary administration policy is important is to eliminate, so one, elimination of perceived salary inequalities. Elimination of perceived salary inequalities. Oftentimes, learner, workers have a feeling that maybe they are not being paid commensurate to their efforts. So when you have a guideline, then this guideline will eliminate this perception, and workers can be able to see what is their grade, where are they in the structure, how do they progress. So this becomes a guideline that can help in the elimination of the perception of salary inequalities among staff. Then secondly, It helps in the attraction, of talented workers, So when an organization has a structured salary arrangement or a policy, then prospective employees are able to look at this kind of a guideline, and if they have the wish to join to that given work environment, so that they can be part of that kind of a workforce. Then number 3, assists in the retention of employees in an organization. So employees who have their salaries determined, their salaries reviewed, individuals don't have to use their own maybe discretion, then such employees can be retained in a given organization to be able to perform their duties and be rewarded or compensated. Then there is the element of engagement levels are higher among staff, amongst employees. So employees in an organization that has a salary administration policy which guides in terms of, say, promotion, maybe lateral transfer, benefits and so on, those kind of employees will be engaged more in terms of their work because they know other issues like, for example, reward management are sorted by this particular salary of compliance with the legal obligations, compliance with the legal obligations. For example, if an organization is supposed to comply with the minimum wage, minimum salary levels, so this kind of an organization will ensure that their policy is very clear. Whenever there is even an adjustment in terms of the legal thresholds, the policy of implementation of salary has to pay above, at the minimum or above the minimum salary level. So that gives the employees who are making decisions the implementation authority to ensure that compliance with legal obligations as far as salary is concerned is enshrined in terms of that particular policy. And when it also comes to, for example, statutory returns, they are position. Then we can have a look now at the components of a salary administration policy. Components of a salary administration policy. Components of a salary administration policy. So what are some of the aspects you expect to get, some of the contents you expect to see on a salary administration policy? So when it comes to a salary administration policy, some of the things that may be handled here may include 1, basic pay, 2, house allowance, 3, traveling allowance, then you have 4, overtime pay, then you have 5, leave allowance, then you have 6, tuition assistance. So some organizations, Lana, have a tuition assistance option where if workers are taking up some course, those workers could be assisted by the management to be able to pay for that particular tuition. And in some cases, there are also some generous employers who are basically able to assist the spouse and maybe the children of the employee. So those could be some of the things that are captured in terms of components of a salary administration policy. Then you have 7, promotion. Then you have 8, transfer. Then you have 9, pension. Then you have 10, deductions. So these deductions could, for example, be for trade union or cooperative or other checkoffs and so on. So these could be some of the things you expect to get on maybe a payroll in terms of the components. So basic pay, house allowance, traveling allowance, overtime pay, leave allowance, tuition assistance, promotion, transfer, pension, and maybe other retirement benefits, deduction, among others. So this could just be part of the things that may be addressed in relation to components on a salary administration policy. Now, for organizations that have a salary administration policy, they may have a document, and this document is what is referred to here, salary administration policy. So we want now to have a look at a structure of a salary administration. Is there one specific kind of a structure? The answer is no. Organizations may have different policies structured in certain ways. But if you have a structure of a salary administration policy, or if you go to an organization, dear learner, or you work for an organization and you have now been told, prepare a salary administration policy. So what are some of the things that may be on that particular policy that you may want to include? So one, the name of the organization. So one, name of the organization. So that becomes at the top, or maybe this one can be a logo. So you may have a logo. So you have a logo showing that this is organization XYZ, this is the address and so on. So the title of the policy. So an organization may now structure it according to their needs. And that title could, for example, be salary administration policy. Another organization may have the title as wage and salary administration policy. So depending on the title that is selected, the title will indicate there. Then number 3, scope of the policy. Scope of the policy. So in some organizations, they may say the scope of this policy covers administrative and management positions, for example. So the scope of the policy has to be indicated. And then number 4, administration of the policy. So it has to be indicated who is administering the policy, who is administering that particular policy. So maybe it may indicate that this policy will be administered by the Human Resource Department or Human Resource Section. So administration of the policy has to be indicated so that if there are questions, those questions are directed to that particular department or section. And then description of the jobs are covered. So in this description, it may indicate that the jobs which are covered here could be human resource jobs, marketing jobs, and so on. So the description could be included. And then number 6, grades or scales for jobs. That should also be indicated. And then there are those particular specific items now that will be covered in relation to that particular policy. For example, 7, entry into maybe jobs or grades. So that should be indicated. For example, if an employee is being recruited for the first time, what is the policy in terms of where this particular employee is supposed to enter? Then number 8, promotion promotion, progression. So the policy has to provide, remember we said it's supposed to be a guideline. So the policy has to provide a guideline when an employee is promoted from a position to the other one. What happens in terms of the progression? How do they enter into maybe the next scale? So that must also be provided as a guideline. Then number 9, transfer. So if an employee is being transferred, what should be the policy? You are being transferred from Nairobi, for example, to Mombasa, from Mombasa to Kisumu, from Eldoret to Nakuru. So if that transfer is taking place, in relation to salary, what happens? In some organizations, including government, for example, what happens is this: if it is the employer who is transferring you in terms of public service, the employee is transferred, yes, but that employee is given 2 months equivalent of salary in the month of transfer if the transfer has been effected by the employer. So that has to be provided for in terms of the salary administration. So if let's say the administrator of this policy is HR, on that month when an employee is transferred, if their salary is 35,000, then for that month they multiply this, they provides, if an employee is being transferred, the salary is paid double and so on. Then there are also issues of number 10, acting in position. So if incentives are supposed to be provided, this particular structure policy, this particular salary and administration policy must provide in terms of the incentive and bonus who is entitled to these particular incentives and bonus and what is supposed to be the formula to be used. So that is also important to ensure that workers don't complain. Then you also have issues of basic pay. That must also be indicated that if the basic pay is supposed to be paid, when is it supposed to be paid? So that again must be provided for in terms of this particular salary and administration of wages, for example. So when it comes to pension, if it is a contributory pension, deductions have to be done. For example, if it's non-contributory, that information has to be provided for. Okay. Then when it comes to issues like now retirement, that must also be provided. There are also issues to do with the leave, and this leave can be leave of absence. So when an employee is on leave of absence, what happens? Do they get paid? If they are on annual leave, what happens? Do they get a leave allowance, or do they get their full maybe gross salary and so on? So this could be some of the things that could be found on a salary, on the structure of a salary and administration policy. And in addition to this, the structure of a salary must also have maybe authorizing officer, and in most cases, in many organizations, that is the CEO, and then this must be dated. Okay, so that particular policy must have the authorizing officer, who could be, for example, the CEO, and that CEO has to sign that particular document and date it, and maybe indicate when will that particular, for example, policy be reviewed. So that is as far as the structure of salary administration policy is concerned. This could be some of the things that could be contained there, including now these other components we have also mentioned here. So dear learner, in our lesson today, we have looked at salary administration policy, and we have indicated that a salary administration policy is a guideline that is used to determine, implement, and review salary levels and structures in an organization. And we indicated that we would look at 3 areas, which is importance of a salary administration policy, components of a salary administration policy, structure of a salary administration policy. And under importance of a salary administration policy, we have said, number 1, it helps in the elimination of perception of salary inequalities. Number 2, helps in the attraction of talented workers. Number 3, assists in the retention of employees in an organization. Number 4, enhances engagement levels of employees. Number 5, assists in legal compliance, for example, minimum wage or salary. Number 6, assists in financial management, especially relating to labor issues. Number 7, helps the organization to better negotiate with trade unions. So, Lana, those ones are just some of the reasons why a salary administration policy in an organization is important. Then we went ahead and looked at the components of a salary administration policy, or the contents. Now, a salary administration policy should capture basic pay, number 1. Number 2, house allowance. Number 3, traveling allowance. Number 4, overtime pay. Number 5, traveling allowance. Leave allowance. Number 6, training assistance or tuition assistance. Number 7, promotion. Number 8, transfer. Number 9, pension. And number 10, deduction. So, Lana, again, these ones are some of the components. The organization doesn't have to have all of them. An organization may capture the ones which are relevant to their needs. So the components of a salary administration policy, we have said that you may have a chance to be able to maybe formulate a policy. So this is just a guideline, and this is what you may find in one organization. There are also things that might not be covered here that could also be captured on the salary administration policy for a given organization. Then we went ahead, Lana, and looked at the structure of a salary administration policy. So how can it be structured? Then we said, number 1, it needs to have the name of an organization and, if possible, the logo, the title of the policy, which captures the specifics of that particular organization, the scope of the policy, number 2, number 3, number 4, administration of the policy, where is it hosted? Number 5, description of the jobs that are covered. Number 6, grades or scales for jobs. Number 7, entry into jobs or grades. Number 8, promotion progression. Number 9, transfer. Number 10, acting in position. So if an employee is acting in a given position, what should be the payment like? Number 11, incentives and bonus. Number 12, basic pay. 13, pension and benefits. 14, retirement. 15, leave, which may, for example, be annual leave, leave of absence. In some organizations, there are also other types of leaves like study leave. Then you have authorizing officer, who is the CEO, dates that particular policy, signs and indicates when that particular policy will be, for example, reviewed. So, Lana, we have looked at salary administration policy under reward management in our lesson today. And before we finish, I want to leave you with an assignment. And your assignment for today, dear learner, your assignment is discuss the benefits that may be enjoyed. Discuss the benefits that may be enjoyed by an organization that formulates and implements a salary administration policy. So, Lana, this is your assignment. Discuss the benefits that may be enjoyed by an organization that formulates and implements a salary administration policy. So that's your assignment that you need to work on to be able to entrench the knowledge that we have gotten today, and also enhance your skill in the area of salary administration in our topic that we have looked at today, which is human resource management and in the practice of human resource management. So thank you.
Hello learner, welcome to Manifested e-learning in Kenya. Today we are discussing on the financial modeling and data analytics paper. The focus is on the December 2023 sitting. We are going to discuss on question 21. The question reads as follows. Eugene Shahira has been provided with a set of historical data by one of his clients, which include a set of assumptions, statement of comprehensive income, statement of financial position, statement of cash flows, and supporting schedules as presented below. And so you can see down here the assumptions. These are the assumptions that have been given to us here, and you can see they're presented in blue for the forecast period, and this is the historical results. We have the income statement, the balance sheet given to us down here, and the cash flow statement just under it. Finally, we have what is called the supporting schedules. We are required using the assumptions presented in the assumptions table, assist Eugene to complete the following statements of forecast period for the forecast period. A, the statement of comprehensive income, the statement of financial position, the statement of cash flows, and the supporting schedules. All of these total to 30 marks. So we go back up and start filling out the income statement based on this forecast period right over here. So the forecast period is from 2017, and we are going to start with the income statement. So the revenue, to model revenue, we have been given the revenue growth rate over here, and so we are saying that we are going to assume that the revenue is going to grow at 5% initially, 4.5%, 4%, 3.5%, and 3% in 2021. So we will increase this 150,772 by a factor initially of 5%, 4.5%, and so on and so forth like that. So let's do that together. So the first thing is to link it with that, and then we multiply by that factor 1 plus now this growth rate right over here, and we close the bracket so that now the model can be complete, or the formula can be complete. You can see in 2017 we expect it to be like that. So we drag it, Control R, and it picks the formula like that. Else we can do the following. If we don't prefer to do it like that, we just focus it like that, and we wait for that plus sign over here like so, and then we drag it like that. So we drag the formulas, and you'll still see the answers are the same. How do we model cost of goods sold? Now we are told that the cost of goods sold is provided as a percentage of revenue. Meaning what? We get the cost of goods sold over revenue gives us 37.5%. I can do it right above, right beside it here. So you can say COGS over revenue will give us the COGS percent, which is this one right here. But how then can we use the COGS percent to be able to model the cost of goods sold? We just get the revenue and multiply it with the cost of goods sold percent, so that now we can be able to model the cost of goods sold, because that is what we're going to remain with over here. Because cost of goods sold over revenue is cost of goods sold percent. So we cross multiply the revenue multiplied by the cost of goods sold percent, then we should be able to have the COGS. And that's exactly what we are supposed to do. We take that and we multiply, or the revenue, we multiply that with what is called the cost of goods sold percent as a percentage of revenue. Enter there. And like the same way we've done before, we just drag it, Control R. The gross profit, because it's a formula, we just drag it, Control R. Now we move on to the expenses down here. So the salaries and benefits, what are we told as far as the assumptions are concerned? We are told that the salaries and benefits are given to us in terms of shillings, 25,000 all through like that. And here we're saying it's going to remain as 10,000 in terms of the depreciation component. So because they're following each other like that, and these are considered to be fixed costs, we just pick them from above. There, just pick it up from there. And also because they're following each other, just drag it like that, put it like that. And then now, fill it out like that. What I've just done, I've just picked this one from here. And you can see from here, this is I-32. Like that. So it's I-32, which is this cell over here. But now, where do we pick it from? We pick it from I-13. This is I-13. I-13 is this one here. So we're picking it just from there. And then also this one is going to be I-14, which is down there. Now we move ahead and try and model the depreciation amortization. In real life, trying to model depreciation amortization will prove to be a bit of a challenge. Determining will be a bit of a challenge because we need to know whether it's going to be reducing balance or whether we're going to depreciation as a percentage of PPE. It's just based on straight line method like that for simplicity's sake. So the depreciation amortization is driven by percentage of opening balance of PPE. So we will initially leave it over here because we do not have the values of PPE given to us directly, and we'll model it a little later on. As well, the interest right here, the interest right over here is based on opening balance. We do not have the opening debt balance given to us here. So what do? We first of all leave those two alone like that, and we will be able to try and model them a little later on. So we put maybe say a faint color there on them, like so, to show that we're going to come back to it a little later on. Because these are totals, the ones in black are always totals, the ones in blue are hard coded values. We just drag them. That. Remember that this value here is bound to change, as well as this value is bound to change because of we've not filled out the depreciation, neither have we filled out the interest. Now the taxes over here, we have been told something about the tax rate right above here. You can see the tax rate is as a percentage of earnings before tax, and you can see it's 28% all through. So what does that mean? That this tax rate will be based on that value times the taxation rate which is given to us right here. So we link it with that one there. And because this is also going to change based on these values given to us there, we just drag it, and because Excel is very wonderful, it's a very wonderful tool, it will just pick everything, or it will pick the formulas based on the values that are inserted right at this point here. This is a formula, so we just drag it like that, moving towards the right. So we have partially filled in the income statement with the exception of depreciation and interest expense. We move over to the balance sheet and try and model it and see if you can be able to model some items. Cash will be the very final part that you're going to fill out, and it will be like what is called the balancing figure as we approach the end of the model itself. How do we model accounts receivable? The accounts receivable, if we can go back to the assumptions section over here, this is the assumption section right above here, you can see we've been given accounts receivable days. We've been given 18. And accounts receivable days is driven by revenue. So it is accounts receivable over revenue times 365. We can get this from these black formulas over here. So if you double click, you can see it is the revenue, or it is rather the accounts receivable. Yes, if you said before, accounts receivable. We divide that with the revenue, and then we multiply by 365 to enable us get the days. Now that we've assumed that the days are going to be 18 over here for the forecast period, and you can see this is the forecast period here, 2017, how do we model the accounts receivable here? We are going to move ahead and say that it is accounts receivable, like that, is given as how we're going to model it over here. We'll pick the revenue, because we've said that we already have the accounts receivable days, and then we divide that, or rather, let me just tell you what you're going to do, because the formula is given to us right over here. You can see this is it over here. We are saying we're going to get the revenue, or rather the accounts receivable over the revenue times 365. So we're just going to do this. We are going to pick the days over here, accounts receivable days. So accounts receivable is going to be given as the days, and then we multiply that with the revenue, and we divide this, all of this, by 365, by 365 over here, 365, that. So days times revenue over 365. We've just adjusted the days. Initially, for us to get the days, we are saying we get the accounts receivable times 365 over revenue, just rearranging this formula. And that's exactly what we're going to do over here. We get the days are here, see where they are, just a second, accounts receivable days there, and then we multiply that with the revenue, then we divide over 365, and we have that value given to us there. So shift Control R, we model that. Inventory is driven by cost of goods sold. So in a similar fashion over here, the formula here, we'll get inventory is given as, or given by, the inventory days times COGS, not times revenue, and here we're dividing against 365. That. So that's what we expect over 365. So that's what we are going to do. We pick the cost of goods sold there, just to double check, cost of goods sold times the days. Which days? The inventory days right here, 73, divide by 365. Once we divide that by 365, then we should be able to get the 11,715. We drag it. PPE, or property, plant and equipment. Remember, this is the one that is going to drive our depreciation component over here. But since we don't have it yet over here, we leave it out for now. The second time coming down, we will be able to fill it out, because this is a formula. So shift Control R. We can proceed on to the liabilities. Obviously, these values are bound to change because we've not filled out the cash, neither have we filled out the PPE. So the accounts payable is driven by cost of goods sold. Same fashion, the same formula over here, only that we're going to put over here payable. Payable for revenue 365. So we look for the accounts payable days. Accounts payable days, you can see the accounts payable days are here, 37, and then we multiply that with the cost of goods sold and then divide by 365. That's what we get. The debt, we will be able to fill out the debt and link it with the debt component from the support like that, because this is a formula here, it's just the total. So this one I'll put it in a different color so that for consistency's sake, to maintain to show that this is the part you're going to come to later on and fill it out. In terms of the equity capital, we are going to link it. So we're going to drive it previous equity capital, then we add any new issuance and repayment of equity. So we come back up over here to the assumption section, this assumption section. Was there any issuance and repayment of equity from 2017? There is what we link it with over here. And we enter. The retained earnings is driven by the previous retained earnings plus the net earnings for the current year, which is this one here. Remember, this value is going to change because of these two, depreciation and interest. Enter. We drag them towards the right. And this one remains like so. So shift, control R. So it picks the formulas as the way they are. Remember, in a balance sheet, we always have a check. This check, with your permission, it will obviously not balance because we are saying that here we have got some missing items. You can see it's not balancing at all. But it's up to our responsibility, based on what the examiners asked us, to fill and ensure that this one balances off, the balance sheet balances off based on the forecast. Now, as far as the cash flow statement is concerned, we will first of all ignore it for now. We ignore the cash flow statement and we'll be able to also do a check for the cash flow statement and write down over here to determine if we're actually cooking figures or not. We jump onto the supporting schedules. These supporting schedules are broken down into three: the working capital schedule, the depreciation schedule, and the debt and interest schedule. These schedules, these three of them, are instrumental towards filling in the missing items in the balance sheet, income statement, and the cash flow statement. So from here, the accounts receivable. You remember we had modeled it just above there in the balance sheet. So we just fill it out, link it with the one accounts receivable here. And you can see the accounts receivable is here, so we link it right over there and we put enter. Because they are following each other with the inventory, I can just drag this sort of down like that and it picks from above. The accounts payable, we also had filled it out or computed it above from the balance sheet here. The accounts payable, as you can see right over here, is 5938. You see, it's okay. Link it like so. Then these are black. It means that they are formulae. To get the net working capital, we get the accounts receivable, we add the inventory, and then we less the accounts payable. That's how we get the net working capital component. So just put it like that and it picks. The change in net working capital is the difference between changes in this year from last year's. You can see the formula there. This value subtracting that value there. So I'll initially fill it like that. Then now I can drag it moving down like that. Shift, Control R. So once we have those values given to us there, we are saying that now the working capital schedule is complete. The change in net working capital is going to be useful in computing some items in the balance sheet or in the in the cash flow statement, pardon me. So we move down to the next supporting schedule. depreciation schedule. Now, we can see something that is very unique from the historical values here. This value, which is the opening PPE, is picked from the closing value here. This value has been picked from the closing value here. This one has been picked from there. So it goes without saying that this value here will be picked from the value there. How much is our capex? Our capital expenditure is representative of how much money we are going to spend out within the year. Outflow of cash, maybe to invest in new machines, new equipment, so forth. And we will link this with the supporting schedule up from, rather not the supporting schedule, the assumptions section. This one here. And we are saying that the capex, capital expenditures over here, is given to us there. So we link it with that and we press enter. The depreciation is based on the opening PPE always. So pick the opening value of PPE and multiply that with the depreciation rate. Remember, we are saying that we are assuming it for simplicity's sake is going to be straight line method. So depreciation, and we are saying we are going to multiply it with that. And we get that. To get the closing PPE, we are saying we are going to get the opening PPE, we add the capex and less the depreciation on the machines. So we drag the formula moving to the right like that, and we can sort of pull the formula towards the right or drag it. Now the final supporting schedule is the debt and interest schedule here. How do we model it? The debt opening, just like the way we are done in the opening in the depreciation schedule, this value is that value, that value is that value. So it goes without saying this value is going to be that value. So pick it from there. And the issuance and repayment of debt can be gotten from the assumptions section, which is up over here. So debt and issuance repayment right now here, we link it with that. So here, because it's a formula, we just drag it. So we drag it over here, it's like that. We wait for the plus sign that looks black like that, which is over here like this, and then we sort of drag it. We just drag it moving towards the right. How do we get the interest expense? The interest expense is based on the opening value times interest on the assumptions section. Interest as a percentage of opening balance here is 3%. Now our schedule, or our supporting schedule rather, is complete. That's what we're saying we're going to do. We drag it. These values over here are going to be instrumental towards filling out the cash flow statement. But first, let's go back up and start all over again from the income statement here and fill out what is missing. We have the depreciation component, so we link it with the ones in the supporting schedule. So we go down on here, and you can see the depreciation is given to us over here. There, enter. The interest expense right here, interest expense is enter. Then we can be able to just drag it towards the right there, Control R. And in a good working capital, where do we pick it from? We pick it from the supporting schedules right here. Change in net working capital, and we are saying we are going to pick that value. So because this is black and it's a formula, just drag it like so. Now we're almost there, but we're not there quite there yet. The investments in PPE represent the capital expenditures. So the capital expenditures down here, capex. Capex, you can see the capex is here. Link it to that. And this one, sort of pull it towards the right, and it's complete. As far as the financing cash flow is concerned here, issuance and repayment of debt, we link it with the supporting schedules, rather with the assumptions tab, sorry, up, debt, here. And remember, they are following each other with equity. So, like that. And this can be dragged like so, because it's a formula, and we can complete this by doing that, by dragging the formulas, moving the right. The net increase or decrease in cash is a formula, because you can see it right above over here. We're going to add cash from operations. We subtract cash from investing, because that's money going out, and then we add cash from financing, so that we can be able to get the decrease or increase in cash. Drag that towards the right. And we're saying that we can then pick the opening cash balance. Remember, this opening cash balance is the closing cash balance here. This one is that one, and that one is that one. So we are saying that we can then link that with that value. This one is a formula like so. So we can then drag these values moving towards the right, and we have the values like so. Now to try and test and see whether this is actually going to balance, because we are through, answered the statement of comprehensive income, statement of financial position, statement of cash flows, and the supporting schedules, we can see that it's still not balancing. Remember one thing, what I had mentioned, that the cash balance is the one that is the balancing figure right here. So let's try and see if you're going to link it, if it's going to balance. So we link this cash value with the closing cash balance right here, this one here, and you can see it has balanced. But dragging the rest towards the right is the one that's going to tell us whether we are on the right path. And you can see it has balanced very well. The cash flow statement has also balanced as well, meaning that we have successfully answered the question presented to us by Kasneb. We hope that you've enjoyed this session of ours, but before we part, there is one thing that I want to try and see and to ask you, whether even if we change these assumptions here, whether it will still balance. It will still balance. That may be the question. So even if I put this to 25 million like that, and leaving the rest the way they are, look at the balance sheet. It still balances. If I put this to maybe 50%, that it still balances. So this issue or this idea of cooking figures cannot arise, because Excel is truthful, and being a true financial analyst means that you need to know how to model all of the three statements: the income statement, the balance sheet, the statement of cash flows, very well. Thank you for being with Manifested Publishers, and God bless you.
Hi student, welcome to another session of Manifested Online Classes. My name is Joseph Kimani, your lecturer for Advanced Financial Reporting. So in this session, I want us we continue with the topic number 1, and I want us we look on this subtopic here to do with the accounting for employees benefit. So as far as this topic is concerned, we're going to look on a number of issues. One, we are going to define what are employees benefits. We look on the various types of employees benefits, and then later on we define some few terms. Then from there we look on accounting aspect of the two types of post-employment benefits, that is the defined contribution plan and the defined benefit plan. But to start with, let's start by defining what are employees benefits. And generally, when talk about the employees benefit, they related to the employees in return or in exchange of the services the employees are rendering. So it is obvious that if you are an employee of a company, you offer some services to that particular company, and therefore the company must compensate you, or in other terms, the company must do what? Must reward you for your what? For your services. So therefore, any form of consideration, any return which you get from the company in form of salary, in form of allowances, and so on, this is generally what we refer as the employees benefit. So therefore, we can start by defining what employees benefits are, and we say that yes, so therefore in this case we are saying that employees benefit refers to any form of consideration given by an entity or basically by an employer in exchange of the services which are rendered by who? By the employee. So what you have said is that if you're an employee of a company, you render some services to the company, and therefore the company must give you somewhat consideration for your what? For your services. Now, in this case, we have various types of employees benefits, and actually we have 4 types of them. So we can look on the types of employees benefits, types of employees benefits. So in this case, we have 4 types of employees benefits. So we can say that there are 4 types of employees benefits. Employees benefit, and those employees benefits, number 1, we have something called the short-term employees benefit. So when talk about the short-term employees benefit, this refers to those particular benefits which are payable to the employees within a period of 1 financial year from the date the services were provided. Or in other terms, you can say that these are those particular benefits which will be paid to the employees within 12 months from the date now the services were rendered. And therefore, good examples of these short-term employees benefits include the salaries, include the wages, and also the various allowances which are payable now to the employees mostly on monthly what basis. So therefore, you can say that these are benefits. Yes, so therefore you're saying short-term employees benefits are those particular employees benefits which are payable within 1 year or basically within 12 months from the date the services were provided. In this case, we have said that good examples of this include the salary, which we know is payable on a monthly basis, and also these include wages. These include what? Wages. Number 2, we have post-employment benefits. So when talk about this particular benefit here, these are the benefits which are payable to the employees once now the employees proceed for the normal retirement. And generally now this what you refer as a pension. So basically what we know is that if, for example, you are an employee of a company and you have proceeded for the normal retirement, or maybe you have attained the normal or basically the retirement age, you are entitled to some benefit which is known as what? The pension. So that pension will be paid to an employee once now the employee proceed forward for the normal retirement. So therefore you can say So these are those particular benefits which will be payable to the employees after the normal retirement. Basically, when we talk about the normal retirement here, we are talking of basically the period which now the employee will proceed for the retirement, basically after attaining the retirement age. And this, in other terms, what we refer as what? This, in other terms, what we refer as the pension termination employees benefits. When we talk about the termination employees benefit, these are those particular benefits now which are payable to the normal retirement age. A company may be undertaking restructuring, maybe to reduce the operating cost, and therefore the company intend to retrench some of the employees. So those particular employees will be retrenched automatically. They're entitled to some benefits which are known as what? The termination what? Benefit. So therefore you can say that termination benefits benefit payable as a result of an entity's debt to terminate employees' employment contract, employment contract before the normal return. The other type of employees benefit, which is number 4, and that is what we refer as the other long-term employees benefit. So when talk about this other long-term employees benefit, we are talking of any other long-term benefit which now an employee is entitled to, other than what we refer as a pension or what we refer as a termination benefit. A good example of what we refer as the other long-term employees benefit includes something called the Jubilee benefit. So Jubilee benefits are those particular benefits which will be paid to the employees when 10 years of operation, the company may decide to give some benefits now to the employees who have worked with the company maybe for the last 10 years or basically for the last 20 years. So therefore, the other long-term employees benefit, we can say that these are other benefits. These are other benefits payable to employees, other than the termination benefit, or what we refer as a post-employment benefit, or post-employment benefit. So therefore, in that particular case, it is important to note that we have those 4 types of employees benefit: the other long-term employees benefit, termination benefit, what we refer as the post-employment benefit, and then we have now what? The short-term employees benefit. So then from there we can proceed and look on something else which is known as the post-employment benefit plan. The post-employment benefit plan. So in this case, when talk about what you refer as a post-employment benefit plan, this refers to any form of arrangement or basically any form of agreement between now the company and the employees, that the employees will be entitled to a pension once the employees proceed for normal retirement. So basically what that means that if, for example, you secure a job with a certain company and there is an agreement between you and your employer that once you proceed for your retirement, you'll be entitled to a pension, or basically you'll be entitled to what you refer as a post-employment benefit plan, then that agreement is what you refer as what? A post-employment benefit plan. So in this case, we are going to look on the 2 types of this and basically how we account for the same. But before we do that, maybe we can define this, and we say that this is a formal or informal arrangement between which then will be used by that particular fund or trustee in terms of paying